if AI algorithms, AI machine learning systems aren't built to learn from the changes, if they're built with, as most models have been, they're built on static data and they don't change the data, they don't learn from the new data, then they're going to work for a while and then fail.
To the Wiggin Sessions. Today I have with me Shah Gilani, and I'm just getting to know Shah a little bit. We've worked in the same spheres for many years, so we're going to plumb those depths a little bit. Shah, what I found most interesting about getting to know you was you started a hedge fund in 1982 on the exchange in Chicago. So I was hoping that you would, two things. One, just to talk about your experience, because that was a while ago. I think I went to my first Grateful Dead concert in 1982.
I'd been to many Grateful Dead concerts by then.
Oh, that's good. That's good to know. but then secondly, I think you were in a different mind space.
I don't know about that.
You're founding a hedge fund while working on the exchange. Tell me what that was like, and also tell me. That was an interesting period of the financial markets because gold was rocking the dollar. Like there was a lot of things going on at that time. So, and you were a young man. You were trying to get your trading strategy together. Like, what was that like back then?
It was a very exciting time. I didn't start the hedge fund. I joined a hedge fund that had an operation in Chicago. Its principal operation was in Chicago on the floor. And it was my first job out of college. I'd gone to UCLA, studied economics there. And I had actually been offered a job in New York while I was in New York. And I was going to start in my new job as an over-the-counter trader, as an associate at a very big over-the-counter trading firm. I had the good fortune of having dinner with a big mucky muck of Wall Street, very well-known fellow who I had some mutual friends and introduced me at dinner. That was the Friday I'd flown in from California to start work on Monday. And he offered me a job at his hedge fund, starting out as a clerk. And I said, well, why would I want to go to Chicago when I have an opportunity here in New York? And this is the epicenter of finance. And he said, because Chicago is where the gunslingers are. And starting out, he said, this is where the derivatives are. This is where all of the great markets are happening in Chicago now. And that's going to be the future is what's happening in Chicago now. And it's really just getting going. And we've established a hedge fund there. We've got quite a bit of capital there. And I'm offering you a position. It's your first job out of college. I don't know if you've got it. I don't know if you'll like it. You don't know if you'll like it. I'm only going to pay you $175 a week. You can't live on that, but that's not my problem. That's the offer. And I accepted it. And that's how I ended up in Chicago. A year later, I was general partner, running the firm, running all of the trading in the firm. So it was a pretty quick ascent as far as a learning curve, but it was wonderful. I really enjoyed Chicago. It was just a crazy market. We, for those who forget or aren't old enough to remember or know, we were in the tail end of a devastating recession. And 1982 there were hard times all around. The markets were being battered, and really wasn't until August of '82 where things started to turn around. But nobody really knew why they were going to turn around or if they could turn around. But we were dealing with a very difficult market and a very severe recession. So that's where I got my start. School of Hard Knocks in terms of learning the hard way, but it was a tough trading market. And that's, I think, one of the things I will say was probably a great benefit to me starting out in a very tough trading environment and learning how to navigate the market and trade and profitably in a very difficult market.
Yeah. So I think a lot of the people that we write to and And somebody that's watching today, they don't understand that because we had such a long period of low interest rates that made the markets pretty easy for a little while. But the last time that it was really difficult, well, there was a couple periods beyond that, but that was really difficult, 79 through like 82, right? Obviously, I don't understand what people were thinking back then because I was younger, but the future seemed less certain from what I could, what I can tell. And then as you're moving into the market today, we're still pretty solid, I think. The market has gotten pretty predictable and pretty stable.
Back then, the Federal Reserve was doing what they could to fight inflation, and that was the problem. We had been in a period of hyperinflation, stagflation. So on top of high inflation, we had no economic growth, and that was devastating. Unemployment in 82 had reached 10.8%. I think there was something like 12 million people unemployed. It was, I believe, maybe the highest unemployment level we've had since the Great Depression. So very tough times. And again, in that environment, nobody really trusted the asset markets in terms of equities for sure, because everybody was thinking, we're still in a recession. When are we going to get out of this? How are we going to climb out of this? And will we ever? There was a degree of pessimism for sure, but things did turn, as they always do. And optimistic investors who were speculating really that there would be a turn started to buy in August. And they bought at the lows. Why? Because things were cheap and this was going to be a turn. If there was going to come a turn, at least you could buy assets on the cheap that if they went lower, how much lower could they go? Because they were already pretty beaten up. So there were a lot of investors that were not even optimistic. They were speculating and trying to make money and thinking that some of these stocks were beaten up enough to make them value stocks and that over time they would move higher. But they didn't have to wait that long, because really in the back half of 82, the market started to move higher, well ahead of us climbing out of the recession. And investors who were front running the expectation of better times were handsomely rewarded, because that was really the beginning of what became a very long bull market as interest rates peaked and started to come down. Investors, newer investors in the last, I would say, decade, 20 years, really don't know anything about those kinds of hard times. The Great Recession that we had was similar to some degree, but the circumstances weren't as dire as they seemed in the early 1980s. The Great Recession, and it wasn't even that long lived. It was 2007 to 2009, and then by March of 2009, we started climbing out of the recession, and the market started to gather themselves at the end of March of 2009 and moved higher and created the greatest bull market that anyone's ever seen. So young investors now have no idea really how difficult times can get, and certainly how difficult they were, but that's not a bad thing. The thing I do worry and concern myself about is newer investors who don't have that experience, don't know what it's like, don't know what can happen, how bad things can get. So fortunately, they haven't seen that, and I hope they don't, but that doesn't mean it's not out there.
All right. So lead me through that. So like moving forward to like 1987, where we had the flash crash, and then the Fed sort of takes control of the markets from that period forward. And I've been calling it the 36-year crisis waiting to happen because Greenspan dropped rates, and then they did it again in 1994. They did it in 1998. They did it in 2001. They did it in 2008. They did it in 2015. We've had the same response, which is you can just borrow money at zero cost, really, every time there's a crisis. So how do you put that into context? You've obviously been in the market for a long time. How do you put that in context and explain it to people that have become accustomed to having low rates during their entire investment career?
Well, the two things to unpack there, so one of them, which you pointed out, and I'm glad you did because it's not brought up very often these days, was what became known as the Greenspan put. When Fed Chairman Alan Greenspan saw markets starting to free fall, he stepped in and lowered rates, and that became known as the Greenspan put. And every time markets seemed to be in some state of flux, where there looked like there might be a sell-off, where there might be a market crash, before we got too deep down into the woods, the Fed was there to cut rates, and that became known as the Greenspan put. Since then, as you correctly recognize and point to, we have essentially had the Federal Reserve at our backs with a generalized put that markets aren't going to go down too far. We're not going to get let the economy fall too deeply into recession. We're going to do everything we have to do, and with the tools that we have, which generally speaking is first and foremost lowering rates as quickly as they can. And the markets now recognize, well, listen, if things start to get really bad, the Fed will step in. Now that we've got inflation and the Fed is battling this latest bout of inflation then they started raising in 2022, which knocked the markets down. The expectation, even as the Fed is raising, is going to be, well, at some point, if they knock the markets down hard enough, they'll start cutting rates because that's what they do. They're not going to let the market free fall. And so investors, even though rates were rising, even though 2022 was a pretty ugly year for markets, it wasn't a horrible year. And then we had the very quick bounce back in 2023 already. Why? Because of the expectation that the Fed, at some point, we've done enough. Inflation will work its way out. And at some point, the expectation is that the Fed is going to be done raising rates and they're going to then have to cut. Because if the markets falter, if the economy falls into a recession, they're going to cut. And investors are once again front running what they believe is the Fed put, which is coming at some point.
Yeah. So I'm going to ask you two questions. One is just how do you trade in these environments? We'll get to that. But for the past 20 years, how do you explain the philosophy that the Fed has been pursuing, which is we can just give away money for free, and anytime there's a problem, they're trying to maintain inflation, and they didn't really have to deal with it until 2022. But how do you explain that? Other than, the only observation I can come up with, and so maybe I'm just challenging your point of view, but the only way we get away with it is the reserve currency, right? We sort of set the rate that people judge their own wealth at. And there's a market value for what money is. Most people in the world don't understand that. So as an investor, how do you address that issue?
Well, I address the Federal Reserve in terms of the truth. The Federal Reserve, I think, and sadly, I would say maybe 99% of people, including most investors, especially newer investors in the last maybe decade or two, have no idea that the Federal Reserve is a private institution. It's not a branch of government. It's a private central bank whose constituents are the big money center banks. It is not a branch of government. Yes, they feign some government oversight because certain members of the Fed
they get backing by the Treasury, right?
They're elected, but the purpose of the Federal Reserve is to be the lender of last resort. And really, when the Federal Reserve Act was brought up and signed into law in 1913, it was really. It was a swindle, in my opinion, that led the public to believe that this Federal Reserve system, they didn't want to call it a bank because banks were distrusted, hated, so they called it a system, was going to do something that needed to be done, which was backstop the economy and be there for the banks, be there for the economy, be there for the citizenry as the lender of last resort if it was ever needed. Well, it was always going to be needed because banks, the constituents, are going to overlend and they're going to fall on hard times. And when they overlend, they don't have the money necessary, or if there's bank runs, they don't have the money necessary and they're facing insolvency. The Federal Reserve is there to give them whatever they need to remain in business. That's the job of the Federal Reserve. That's morphed into just doing whatever the Fed needs to do to make sure that the banks make money. That's the big banks are the Fed's constituency. That's who they look after. They're not looking after the economy. That's a byproduct of what they're doing for the big banks. We saw that clearly as possible during the great financial crisis, when the banks over-leveraged themselves and got caught up in the subprime mess, which they created. Fast forward to all of the banks in the United States, all of the big banks in the United States were technically insolvent. And of course, that we couldn't have them fail because they were too big to fail. The economy would implode. So the Federal Reserve prints money, bails them out. And the legacy of then creating profits for the banks in order for them to be able to meet reserve standards that they had to, and capital requirements that they didn't meet, the Federal Reserve entered into this quantitative easing program, which was supposedly about combating the boogaboo of deflation. We weren't experiencing deflation. The banks were insolvent, and the Federal Reserve basically came up with quantitative easing to reflate the banks, to create massive profitability for the banks and made them bigger. So they ended up buying assets of other failed banks, became bigger, and they are the go-to banks. We now know since then they are too big to fail. They always have been too big to fail. That's the legacy of the Federal Reserve. That being said, for me, the Federal Reserve providing the put from the Greenspan put onward means that the market's a lot safer place to invest in because it's manipulated. It's manipulated by the Federal Reserve, and it's because the banks are always involved in the market and their clients are involved in the market, and they don't want to see that crash. So the Fed is always going to be there. Barring some slip up where something black swan happens and they don't see it coming, we could see a crash. But anything that we see that is visible, the Fed will be there to arrest in terms of the market falling too far, too fast. And that means it's a lot safer for investors to take longer term positions.
How do you relate that to, we just had a banking crisis in March of this year, which was like a short headline story in the news for a little bit. The banks are still under stress, in my opinion. And then also you have the FDIC, which is underfunded if they're going to be the backstop. How do you relate that to what's coming in the future? Like, they claim they can create a stable market for everyone to invest in, but can they?
Well, the FDIC doesn't have nearly enough money, never has had enough, never will have enough money to backstop all depositors. And what they did is they created an FDIC put, not unlike the Greenspan put, where basically they came out and said, as far as Silicon Valley Bank, as far as First Republic, as far as Signature, we've got you all covered. It didn't matter. Silicon Valley Bank, about 88% of the depositors there were uninsured, meaning they had put more money in the bank than they had FDIC coverage for, which is $250,000 per an account. So there was that much money in there that 88% of the money, of the deposits, were uninsured. So if the bank was to fail and investors who depositors were only going to be made whole to the tune of $250,000, the losses would have been staggering. So the FDIC said, well, we will cover you all of it. Now, the only thing they could do there was really try and sell the bank and make the depositors whole in that sense that, okay, you don't have to, the bank's not going to fail and you're going to lose your money. We're just going to transfer it somewhere else and we'll still protect. But that's the bazooka. That was the FDIC's bazooka to stem what was a deposit exodus that was frightening. So yeah, now we've got an FDIC quasi put, except I don't know if we have another crisis and it becomes more systemic, whether or not that will ever hold up, because that's certainly not the case. They don't have the power to do that. They don't have the money to do that. The Treasury probably wouldn't even want to backstop them doing that. The Federal Reserve would probably have to step in and say, well, we can print the money. It's all going to be good. And that's what I think investors are looking at. Well, oh, this banking crisis, it seems to have passed. Nothing really bad happened. These banks got taken care of. The depositors got taken care of. I don't see it that way. I know you don't see it that way. We're now seeing rating agencies cut credit worthiness of a lot of banks, and then a whole bunch more are on negative credit watch. And that to me is indicative of the fact
what they call is the contagion index.
Yeah, there's more pain to come. The banks aren't out of the woods, Addison, and you know that as well as I know that. And because the thing that caused the problems for Silicon Valley Bank and Signature and First Republic weren't what's being called idiosyncratic. It wasn't just like, oh, these three had these particular problems to their bank, and part of it was management and how they handle. No, the problems are the same problems that the other banks are experiencing. In the digital age, depositors can leave like that. You don't have to walk into the bank or stand in line to get your money out of a bank. You simply, make a few clicks on your computer and your money's gone somewhere. And a lot of the money is coming out and is going into money market funds where you're getting a good yield for a change. So the banks are not out of the woods. As rates have been working their way higher, the problems that existed in March, meaning the banks, the value of the loans on their balance sheet, the value of the securities they held, yes, U.S. treasuries, risk-free treasuries, the value of those treasuries that they held and the value of the loans were going down as rates were going up. And now that rates are ticking back up, the same thing is happening. The value of those loans on their balance sheet, the value of the securities that they hold, treasuries, for example, with 2% yield, when you can get 4% now in a 10-year, they're underwater. So the problem that they're having is as rates continue to tick higher, their balance sheets look worse. At the same time, there's this brokered deposit phenomenon that's going on that people don't realize. Banks look better in the second quarter. Why? Because they say, look, we have more deposits. Deposits are coming back. Our deposits are higher. So the crisis is over. The reason that deposits are higher at banks is because banks are buying deposits. They're going out into the brokered deposit market and buying deposits. And the way they do that is they offer CDs with high interest rates. So I have CDs now at a bunch of banks. I'm getting 5.5% on 1 year CD. And so that's hot money, because when my CDs, for example, mature in a year, I'm going to go around and see, well, who's got the highest rate now? I'm going to move my money out of those banks. So these banks are paying, and they're paying up exorbitantly, in my opinion, for deposits. So yes, oh look, we're out of the woods. We have more deposits. We don't have deposit flight. We're taking in deposits. They're paying for them. That's a problem, because when those deposits, those CDs mature, that money's going to leave. That's not sticky deposit money. That money is hot money. It's going to go look now for the next highest yield, whatever other bank, wherever other opportunity market fund it's going to find. And those banks are going to find themselves with upside down balance sheets and depositor flight. So the banking crisis is with us.
Yeah. So I want to ask you a little bit about that, because there's two forms of a banking crisis. If you're an investor in banks, that's an issue. Like, you got to look at the balance sheet of the regional banks mostly, but also the contagion index indicates that there is a bunch of unfunded liabilities on the big banks, right? So if you're an investor in banks, that's one thing. I think that is probably a small number of people that we're talking to right now, because banking is a complex issue, and there's not a lot of you have to be pretty sophisticated to invest in banks, because you have to understand what's going on there. But the second thing is that the financial system is determined by how successful the banks are. I wrote this thing called, in an economic crisis, the banks go first. That's what happens. Like, literally, that's what happened in the 30s. It happened in the 70s. And if you look around the globe, it happened in Germany. It happened in England. Like the banks go first because they can't finance the unfunded liabilities that they have. And that's what we're looking at right now. But nobody is forecasting. They're not looking at the trends. And so the bigger issue then, if you're if you're investing in banks, that's one thing. You could lose your money, no big deal. But the financial system is under stress.
Yeah, there are pieces to that people don't realize. One of them is if you have deposits in a bank, especially if you have deposits beyond the FDIC insured limit, you are invested in that bank. You don't realize it, but you are invested in that bank. And there are issues that you might encounter if that bank folds. And if you have deposits beyond the insurance limit, you may not get those back. So you are invested. Investors need to be aware of that. You're invested whether you realize or not indirectly in a bank if you have more money there than the FDIC insurance covers. Number two, I trade banks. There are about 435 banks traded on major U.S. exchanges. So there are plenty of banks to trade. And as a sector, as a group, it's pretty easy to have an idea of where they are as far as the money center banks, how they're doing, how the big regionals are doing, and how the community banks are doing. And there are three different buckets. You have to look at them differently. But to your point, collectively, the banks really determine whether the economy is going to grow or implode. And if banks have problems, if banks start to fold, if banks become insolvent, then credit throughout the economy is going to evaporate, and we're going to have a contraction of monumental, probably some monumental degree. But the banking system right now is being, I would say, looked at as it's been taken care of, but it really hasn't. The Federal Reserve and certainly regulators don't want to panic investors, whether or not you're an equity investor in a bank. If you're an equity investor in a bank and you start selling your stock and the price of the bank's shares go down, that's their primary source of capital. That's their first tier capital, is their equity capital. If that starts falling, so people are selling banks, they're shorting banks, and the equity prices are coming down, that impacts the banks immediately. And that means that their earnings are going to get hurt as their equity comes down. They have to replace that falling equity with maybe more brokered deposits, maybe borrowing from the Federal Reserve discount window, all kinds of issues, because they still have to maintain reserves against their quote unquote assets, their loans, and the assets that they have on their balance sheet. And we can fall into a banking crisis very quickly if we don't mind our P's and Q's. And as far as the regulators going, they're aware of that. They're starting to raise some standards, and that's going to create even tighter conditions. So if the banks
it seems like the regulators are like on a big PR campaign, like, we got this.
Yes. Well, they could be their own worst enemies if they say there's a problem that we need to fix. What? There's a problem? Then you have equity investors selling the stock, and they create the problem by essentially warning investors that there is a problem with the bank. So you'll never hear anything from the regulators other than things are good. The system is sound, as Janet Yellen has said. That's what they always say. That's what they said up to the last minute when Lehman folded in 2009. This is what they said, through October and November of 2008, when things were so bad. And actually, I would Lehman in 2008. Things were so bad. And for those of us who were watching firsthand, front row seat, so to speak, and those who didn't know what was going on, don't know how close we came to reverting to a barter system. That's how bad it was. That's how problematic the banking system was. The economy would not be sustainable at any level if the banks were allowed to fail. And what did everyone say? All the regulators said, no, it's fine. We're all good. That's what they're always going to say. So you're not going to see a banking crisis happen. There's not going to be any red flags unless you understand what to look for as far as looking at the bank balance sheets, understanding how they operate and what the problems are. But we're never going to hear from the regulators that there are really serious problems out there that we're addressing, because that will create the problem they're trying to solve.
Yeah. One of the questions I get on a frequent basis is my bank solvent? Is my bank safe? Like people will say a bank with Bank of America or Wells Fargo or whatever. Truist is a new one that I've gotten questions about. But I don't think that that's really the issue. It's not that people's deposits are, like individual investors, their deposits are not in danger because you have the backstop of the FDIC. There is a debate about whether they can handle an outright bank run, but that's not really the issue, in my opinion. The real issue is they're overstretched and sort of arrogant about the way that they're confident that the financial system is going to persist. I think a lot of this is dependent on the
They have the luxury of that arrogance, which is what I define it as,
which is
because they know they have the Federal Reserve backstopping them. So, and I get asked that question also, and it's, I have this bank, that bank, and my answer is very simple. It's just, yes, your bank is safe. You're safe as long as you don't have unfunded deposits there. In other words, if you don't have FDIC insurance above your deposits, then you got a problem. You might have a problem. So what is really, if you're worried about that, then you put your money in Citi, Bank of America, JP Morgan Chase. Why? Those banks who are the constituent banks that run and control the Federal Reserve are too big to fail, and they'll never be allowed to fail.
Insane. Yeah, I think that's true because they can't afford. Like I was studying the FDIC contagion index, and I'm looking at it, and I'm like, there's no way any of those banks could go down, because it would take the entire global financial system down. And so we're in this kind of weird conundrum where there's a lot of people that are aware debt is fueling the system, but you can't do anything about it right now. I mean, you can invest as an investor, and I'm going to ask you about that in a minute, because we talked about that the other day, and I thought you had really good answers. So we're going to talk about that in a second. But if you're aware that the entire system is debt financed, one way of saying it is like, don't worry about it. It is just what it is, and you have to deal with it.
Well, it's something that I don't think an average investor needs to worry about, unless you are, as we said earlier.
But people do when they become aware.
There's also great investments should be held on to. I'm for long-term investments in quality companies, especially great tech companies, because the future is always going to be in technology and in disruptive technology. And those companies are always going to do well. It doesn't matter if they take a hit because the market takes a hit, because there's going to be a systemic bank issue. And I think, again, as we've been talking about, I think there is one out there right now. It's being muffled, but I think we're going to see it. I think probably we'll see it if the backs of the commercial real estate sector start breaking, and they are breaking. I had dinner last night with a dear friend of mine who is a banker, and his area is commercial finance. And I asked him outright at the table, I said, what's the state of the commercial real estate market right now? Is one word: bloodbath. I said, is it bad or is it going to get worse? He goes, oh, it's just starting. He said, it's already bad. He said, but there's a lot of kicking the can down the road. There's going to come a point where, that can is going to fall off a cliff and things are going to break. So,
I think that's accurate, because just from my own experience, I live here in Baltimore and I've been doing what I do for 30 years, and there's no one downtown anymore.
Yeah.
Like commercial real estate is dead in Baltimore. And I've been to a bunch of cities. I went to Memphis for Freedom Fest. I was in Austin because we were looking at a college for my daughter. And we went to Indianapolis for a concert. Like I've been around a little bit this summer, and the inner cities are dead. And that drives the commercial market.
Well, work from home has been something that's been around for a while, and certainly before the pandemic. But the pandemic hit home as to, okay, if you can work from home, why not? And yes, office, I think we're getting back. We're now slightly above 50% occupancy rate in office space. But for the longest time, we were in the 40% range. So we just started to work our way back up, and finally over 50%, I think, in the last maybe month or within the last quarter. Whether or not we can stay there remains to be seen, or how much higher are we going to see occupancy? I don't know. Speaking for everyone I know who works from home, was able to work from home for a while, they want to continue to work from home. Nobody really wants to go back to the office. And yes, businesses are forcing their personnel to come back. But I think the lifestyle now is, hey, listen, I'm more productive. I can be actually more productive working from home. It's better for my family. It's better for my mental health. And I think that's likely the trend. And that means the things that you're seeing, that I'm seeing in whether it's downtown Manhattan, or Midtown Manhattan for that matter, or I was just out in Los Angeles, Chicago, even Miami, which is seeing some influx in.
You know what? I'm not sold on the Miami story. I think that they've got Citadel moved down there with Ken Davis, so they like made a big deal out of that. But their occupancy rate is down like 12% year over year. Yep. Like people are moving out of Miami also.
And they're still building. The cranes are back. So, they're still building, and because
I don't know how this is going to resolve itself. I just don't see people moving back to cities.
Well, as far as the commercial real estate, the landlords are going to have to do something. I mean, defaults are already pretty bad. There's been over $400 billion in defaults so far this year in commercial real estate. And some of the biggest names have walked away from buildings, including Blackstone, BlackRock. Some of the biggest names that you would never imagine would ever walk away from multi-million dollar, $100 million, $200 million buildings are handing the keys back to their lenders and saying, here you go. We can't afford to refinance it. We don't think we'll ever have a rent roll big enough in order to make this a successful investment. So we're just going to cut our losses. And again, if we fall into a recession in the back half of this year, that is going to be the tipping point where the commercial real estate market is going to absolutely implode, and we're going to see the banking crisis that we thought we were done with reemerge with a vengeance.
Yeah, because the bankers who bet on those buildings are not going to be able to reap the rewards of their investment. I mean, that's basically what's going to happen.
Yeah,
sorry, I'm bringing up the REIT idea, the commercial real estate, because I think that that's one component that a lot of people have sort of bet their careers on rising real estate investments, and I think that's a good investment, and that will evolve through the post-pandemic economy. I think that's going to be fine. It'll just move to somewhere else, and people will figure out how to make that happen. There is a transition that is going to be difficult for some people. The other thing is that, so I'm coupling this with the parallel of consumer sentiment to what people think about commercial real estate. Like everyone thinks it's going to come back eventually. And right now, people are over-indebting themselves because they think the economy is going to come back eventually. So they're like, I was just reading, I think this morning, that credit card debt among individual investors or individual homes is at the highest point it has been since credit cards were mailed widely in the 80s.
And,
like we're betting on the future in a way that is difficult to comprehend.
well, we're betting on consumers' ability to continue to leverage themselves. And
Yeah.
a lot of the talk, Addison, that I hear, the chatter is still out there, is that the consumer is in good shape. I don't see it. I don't see the metrics that I look at. I don't see, yes, I understand that, okay, there was a great savings rush, during the pandemic when people weren't out and they were collecting stimmy checks and they, whatever savings they had, they weren't spending because there's nowhere to go. I get all that. That money's all been spent now. We're back down to a savings rate that's, again, plumbing, record lows. So that period has come and gone, and investors have spent the money and they're out spending it now. Traders know that what's happened with some of these travel stocks is, well, probably going to go, south at some point, because everyone wanted to get out, is getting out.
We did well with Carnival, and we were happy about that.
Every airline, every airport I've been to, I've never seen anything busier. Every flight is booked, and the stocks have done really well. But that's based on, yes, folks want to get out after the pandemic. They want to, it's about experience as opposed to buying things. It's like, let me go experience the world and travel here, do this, do that. But they're getting tapped out. Over $1 trillion in credit card debt, and the interest rates, and heaven forbid you're late on a payment and you get the charges, and then that maybe trigger certainly higher rates going forward. And I told the story the other day. This is how crazy it is. And I didn't realize how crazy the interest rate charges are on credit cards, because I use American Express and pay it off every month. So I get a solicitation from Barclays for a credit card, and it's a substantial line of credit. And I've never banked with Barclays before, but they offer me a very substantial line of credit and a 1 year 0 APR for any balance transfers. Or if I just wanted to write a check for a lot of money and put it somewhere, no interest for a year. Great. The regular rate, 1 year from the day, take a guess of what the interest charge is.
Well, I already guessed before, so I already know.
29%. 29.9%. If that's not usurious, I don't know what is. So the consumers who are piling debt onto their credit cards, this is what
they don't know what's coming.
This is what they face, and that's tragic, because most of the time that's you're indebted to these credit card companies for life.
Yeah. So I find this whole subject fascinating, because I think I'm a little bit like you, where I manage my own debt levels and I'm at really low mortgage rates because I took advantage of ZIRP like a lot of people did. So like I'm okay with it, but I just fear about the people that are making financial decisions moving forward, because they don't know what's coming, and it's also gonna have an impact on the balance sheets of big S&P 500 companies that are mostly selling products to consumers. Like that's what I call the balance sheet recession. Maybe we're not going to see a recession in terms of unemployment, which is typically how it's measured, but consumers are going to get tapped out, and you can just see it happening. No one really pays attention, but you can see it happening.
I see it happening. I see the consumer maybe lasting a couple more quarters. I think we'll certainly see it in the holiday spend. I think that's going to be off. And it's been off for the last couple of years.
They're going to extend themselves again, don't you think?
Yeah.
They're just going to be like, yeah, it's the holiday season, I'm going to do it.
And that probably will be the final straw. And if we're going to see a recession, we'll start to see it, if not before, in the first quarter of 2024, when these consumers are tapped out and they start missing payments, and banks are starting to, see delinquencies on loans. And then there's the auto loan market. I mean, that's let's talk about over leverage there. Consumers so over leveraged with their auto loans. It's rather, there's a shadow over the consumer up ahead, and it's going to get darker. And that's what worries me most about, as far as how can the economy grow if the consumer, which depending on whichever metrics you like, whether it's 2/3, 3/4 of GDP is consumption, we're consumer consumption driven economy. What happens if the consumer stalls out?
Yeah, I mean, it gets funky fast.
Yeah, and I think then we'll see.
No one realizes it.
We'll see some of these. We'll see some of these stocks that have been elevated, like the airlines and like some of these travel stocks. We're gonna see the fluff come off that fairly quickly when before we see that actual turn in terms of consumer delinquencies on their debt and outstanding, et cetera. We're going to see some of these stocks start to turn tail.
Yeah. So what I know about you and your trading strategy up to this point is you don't really care about these big macro trends, other than if you could just identify them, you can trade them. Like you can trade up or down. Yeah, and if you're aware of the trends, you can make trades that even if you have a dour. I get accused of being a gloom and doomer all the time, but I'm just like, really, I just want to know what could go wrong.
You're a realist.
But you can trade up and down. So
exactly. A lot can go wrong. And my mantra for going on 40 years is there's always a place to make money. So, being in the market, I'm looking for opportunities, and whether I'm buying or selling or shorting, it doesn't matter to me. I'm just looking for opportunities. Again, we've been talking about the banks, for example. I think they've had a bit of a hiatus from
banks are oversold.
And I think the banks come down. There's going to be an opportunity to make money on the banks coming down again. So there'll be, buying. I'm not a big advocate of shorting anymore. I used to short a lot. Shorting has become much more difficult. It's much easier to make downside plays by buying put options, and even better yet, by buying put spreads. And that's a very easy, inexpensive, and very risk-controlled way of playing asset classes to the downside. So I'm generally speaking a long-term bull, very bullish, but doesn't mean there aren't opportunities to make quick money, because the adage that I think most people know is stocks take the stairs up and the elevator down. So on the way down, if you're on the right side, you can make a lot of quick money, and there's always opportunities on both sides.
Well, give me like 3 general ideas that you have for trading right now, just like 30,000 foot.
Well, number one on my list right now is I would say safety, because as far as the banks, as far as the impact that we would have with credit tightening, with banks in difficult position, and what that would do to the economy, that worries me. So I want to be cautious in here, and I'm looking for, and I own some great companies that have great dividend yields, and I'm fine with those because I expect appreciation out of those. But in the meantime, if the market goes a little sideways, the market goes down, I would add some of those positions if they went down. And if the market goes up, if the economy moves higher, then these positions will do well anyway. So I'll give you 3 of them. I like the energy space in here. I like energy has been volatile, but I buy energy stocks when they come down. And my favorite is Devon Energy. The symbol is DVN. This is just a very well-run company with a huge profit margin, and it's kind of on the down low right now. I think you can get it around 51 and change right here. It's got a dividend yield of about 6.8% dividend yield. So to me, I'm being paid to hold an energy stock that I think has tremendous appreciation potential. And we know what's happening with fossil fuels. So they're going to continue to pay the dividend, if not increase that dividend. The payout ratio is something like 61%. So they got plenty of room to increase the dividend.
That's a
And
lot.
if these fossil fuel companies are under increasing pressure and they're not going to go out and explore for oil and gas, they're going to have to do something with the profits that they're making when prices start to edge higher. And I think we are going to see higher energy prices long before we end up with some all-electric environment, which, by the way, people forget, we got to generate electricity some way. And the principal way of generating electricity right now is fossil fuels.
Yeah.
So the prices aren't going to come down.
I have a lot of opinions about electricity.
Yeah. So Devon
We
Energy
don't have to do that now.
But again, and in keeping with I like the yield story, and again, the stocks that I like that have big dividend yields, I have to feel that those dividends are safe. Otherwise, I wouldn't be advocating those positions. But in an environment where you can get 5.25% in a money market fund or in a CD, I want a dividend yield that's higher than that, and I want appreciation potential also. So another one is Blackstone Minerals, as symbol is BSM. Now this is
that a subset of Blackstone?
No, it's not. But they have mineral rights, so they don't have any capital costs really, because they're not out digging and exploring and mining. They own rights in mineral rights on land, and they have fabulous deals. They're tremendous contracts and tremendous dividend. 10.61% dividend yield at $18 a share. There's 18 and change. So you have a phenomenal dividend, 72% payout ratio, meaning the net income available to common shareholders, which is my favorite measure of real profitability. Of that, they take 72% of that and they pay it out as a dividend. So it gives them plenty of room to continue to do other deals, look for other deals, and grow the company. So at $18 a share for $10.61 percent yield on that $18 all day. So
are they mostly operating in North America?
Yes.
Because I think that's always important because of the legal structure.
Yes, and another reason it's a go-to for me. So it's a core position of mine. I also like the miners. I like buying stuff in here that is starting to get a little bit beaten up. And some of the miners are my favorite of the big miners is Rio Tinto. Again, it's another great dividend yield here. The payout ratio is a bit higher at 90+%, but we're looking at 6.28% with the stock trading right around, I think it's around 63 and change. Because when we get back to growing, I think it'll probably be the second half of 2024. I think materials and minerals and the miners are going to do phenomenally. So I'm looking to buy them on dips.
Yeah, it's also a long-term play because the interest in the politics of climate change and the technology that's going there is just it's not going to produce as productive energy at a cheap price that we thrive on, and we need minerals, we need oil, we need fossil fuels, we need the things that are making the lights shine on my face right now.
and we always will. And the world keeps growing, and as far as the market in general, the reason I have been, I am a major bull is as my thesis from, I'm going back 5-6 years ago now, a lot of calculations and stuff I did. And then it was easy to confirm what my thesis was, which was there's nowhere for the markets to go but up, because there are fewer shares traded every day between share buybacks, between M&A, between the dearth of IPOs, there are actually fewer shares to trade every day. And there's more capital being created globally every day. So more capital chasing fewer shares, i.e. bull market. And that's the long-term view I have. And things that may change that are we see a lot more IPOs, but we see companies getting larger. And the larger they get, the more profitable they become, the more they're buying back their shares. And so again, fewer shares. And even these big mega cap companies, yes, they'll issue more shares in order to offset the options that they give their management, et cetera. But still, the net number of shares outstanding for the companies is coming down. And with capital being created every day and economies starting to grow, whenever they start to grow robustly, that'll create more capital. It's going to chase those companies. And so I'm long-term bullish.
Yeah, I get that you are, and I understand your perspective, but the macro picture of like rising debt at the national level, the things that I worry about, like that doesn't change your picture. And you know what? I'm starting to just think that whatever I care about doesn't matter anymore because the debt keeps rising. But how do you factor that into your own investment horizon? Like the way that you look at companies and stocks. I agree with you on the energy thing, by the way. Like, I think that's going to be a bull market for a long time because we need it.
I do. I absolutely worry about debt levels, whether they're corporate debt levels, whether they're consumer debt levels, and moreover, government debt levels. I absolutely worry about the quality and solvency of sovereigns. We live in a world where there are always sovereign defaults. And whether or not Japan or the United States or another country that we wouldn't expect to default does default is a possibility. The way I handle that or work with that is simply to work around it. And by that, I mean, I don't worry about something that I have no control over unless it's right front and center, or if it's becoming such a pronounced narrative that it's starting to impact asset markets, then yes, then I'm going to trade it a certain way, a different way. But until I see it happen, I'm not worried about it because it's not affecting the things that I'm trading. I mean, in some sense, there are reactions to, for example, the downgrade, Fitch's downgrade of U.S. credit worthiness in terms of the Treasury market. I think we're going to see a long-term impact of rising rates, and it's going to cost the Treasury more to issue its debt. And I think there's a way to play that. You can make money off of that. You can make money off of falling bond prices and rising yields. So I'll look to play that. But as far as the default in the U.S., no, I'm not going to play that. There's no way to play that because I think that can is going to get kicked down the road as far as I can see. Same way Japan has kicked that can down the road, same way every other country has. Other
I think the exceptions. To me, the Fitch story is pretty interesting because they downgraded by one negative. So they went from AAA to AA plus, which doesn't really mean anything. And also Fitch is a publishing company, just like I run a publishing company. Like it's just their opinion. But what I did find interesting about it was that they specifically identified political discord in the country as a factor that would inhibit the U.S. from being able to handle their own books. Basically, the government can't fund its own initiatives or whatever. That's what they were saying. And what happens is it drives yields up because they have to raise the money to fund the government.
Addison, that struck me like a bolt of lightning. That was the major takeaway for me was the mentioning governance. And
yeah, because they don't do that. Moody's did.
They don't do that, right?
2011, but they didn't mention that.
Right, right. So when they mention governance, to me, it points to what I think is how our country is governed. Is somewhere between maybe a third world country and a banana republic, and as
Yeah, well,
divided.
we're sliding in the, bananas are great. I love bananas.
So do I. But that's the
Covered us.
direction we're in already. We're there, and we look at the politics, and it's frightening. And just no wonder that the world is looking at us and thinking, what happened to America, the
Yeah,
shining city on the hill?
try to answer this question for me. Like, if we all recognize it, why can't we do anything? Where are the people who will stand up and be reputable and honest?
Gosh, I wish I had an answer for that. I don't know. I think they don't want to be drawn into the mud. There are certainly people out there that would make outstanding government leaders. A lot of them
Stand up, though.
are afraid. A lot of them are afraid to be torn apart in the process, because that's what happens. It's so divisive, and it's such an ugly, dirty game that I think the really good, solid people are afraid to get involved because they bring them down, bring their families down, bring them into that ugly cauldron, and spit them out, and that's unfortunate. But I think we will see. I hope, and I'm sure we will. This is I think the greatest country on earth, and we will see some fantastic people step up, and I think we're going to get the government that we need. It's just a matter of when. And I don't see this cycle. I don't see anything that gives me great hope in this election cycle that we're coming up to. But there's always the future.
All right, I'm going to ask you one last question because we spent a lot of time talking today. But how do you see AI affecting the markets? And that's the question. But I'm asking because there's a lot of people that think that, like, they're in the writing business or publishing, or it was one of the issues for the Actors Guild when they went on strike, that you can like AI is going to change the landscape of how the economy functions. And I'm just wondering what you think, how it's going to impact trading, because if I don't know what the answer is, but if AI can change algorithms on the fly based on input that the market gives them, is that going to change the way that we think about investing?
Yes, I think it will. First of all, it's going to change everything. AI is going to change the world, period. And that means that every company that employs AI, and everyone's going to have to employ it, is going to have some measure of success with it. And those that do have more than a measure of success are going to do exceptionally well. So that's going to change how people trade different companies. Investors now have to look into what they're doing with AI, how it's going to benefit them, top line and bottom line. So there's that aspect. But as far as trading itself, yeah, there have been algorithms out there that are AI driven for years that have been successful. The difficulty with creating AI driven, machine learning driven methods to trade markets is they can't be static. They have to constantly learn from that because the markets are constantly changing. And as AI changes companies and their profitability profiles, it's going to change how stocks trade, and it's going to change a lot. And if AI algorithms, AI machine learning systems aren't built to learn from the changes, if they're built with, as most models have been, they're built on static data, and they don't change the data, they don't learn from the new data, then they're going to work for a while and then fail. And that's always been the case. And AI-driven algorithms and systems that I have seen work brilliantly for a while. And if they don't learn, if they don't not programmed properly to learn properly, they eventually putter out, fail, because the market changes and things change. And so AI that learns how to adapt to changes, learns how to see the changes coming, and changes its methodologies for picking stocks and entry levels and exit levels. That's going to come. And whether or not the public will have access to some of those things remains to be seen. But if I have anything to say about it, yeah, they will.
Well, so let's just talk about that for a second, because even you and I were like, what is AI? Like, what actually is it? Like, they're machines that are learning how to process data that can change the prices of the stocks that you invest in. That's the way I understand it. But once it gets started, I don't know, I don't even know how to phrase this. Once it gets started, it can learn on its own, and it can just keep processing that data and then change your entry price and exit price. And I don't know if we should be concerned about that or not. I love AI, for example, as a writer, because I can call up Bard and find out all the information I need to know in like 20 seconds, and it just prints it out, and I'm like, oh, that's cool. But I do worry that it will have an undue influence on human behavior in markets, because we count on markets to give us price signals, right?
Well, price discovery is that's a human phenomenon as far as investors making their bets. And a lot of that is driven by psychology, and lately the catchphrase is narrative driven investing. Mm-hmm. And if you just really follow narratives, and whether you're on top of them or even a little bit behind but catching up, and if there's momentum in those narratives, you can make money playing the correct side of an asset class. But what AI is capable of doing is seeing the changes. For example, we not all sectors may rise in a bull market. Some of them, there's going to be some rotation in and out of different sectors for different reasons, et cetera. And a good AI model would see that maybe the momentum is waning in financials and it's picking up in materials or consumer discretionary. And that's where AI is going to come. It's going to start to see these things before it's evident to traders. And that will push stocks in different directions. And so we're going to see that. It's going to make a big difference. But the question of how available it's going to be, if it's available, I'll say universally, meaning to a tremendous number of investors, then it won't have any impact, because everybody will be crowding into the same trades, and there won't be an advantage to it. So depending on how widely distributed some of these models are and who has access to them will determine the efficacy.
So are you concerned about its influence on the market? Because I think we're both historians of the market in whatever capacity we are, but it's mostly human driven. Do you see an undue influence of machines that I don't know how to think about that? So I'm asking what your opinion is, because I believe that all innovations create some discord, and then we just have to learn how to deal with that. And I feel like that's happening in the markets right now.
It is happening, Addison. And again, I don't think it's going to really impact the broad spectrum of quote unquote markets or asset classes in general. Right. It's going to impact it's certain people, certain firms, certain maybe hedge funds, certain investor groups who have access or create the right kind of AI will have advantages. But this doesn't mean that there's not going to be plenty of money to be made by everyone else, by all other investors. And it's happening already. We see that with the likes of Renaissance. We see that with the likes of Citadel. We see that likes with really smart investor groups that are doing things that are making extraordinary sums of money. D.E. Shaw has been doing it forever. Lots of companies. I can name a whole bunch of investors that I know that have been doing it for a long time, and they're incorporating everything they have to because it's about making money. So those types of investor groups and firms will and are working on it and already have it, and they're going to perfect it, and then someone will find something better. So there's plenty of meat on the bone for everyone else. They're not going to command the markets and take away opportunity in general. They're just going to benefit themselves. And there's plenty of money to be made. The markets aren't not going to change that radically. There's always going to be opportunities. It's the greatest wealth creating vehicle ever conceived.
Yeah, I agree with that. Do you think we're only talking about it because NVIDIA crested $1 trillion? Probably, right?
Talk about narrative stock. If you caught the narrative that AI and NVIDIA, boom, you would have had a good year already.
Yeah. All right, cool. Shah, good to talk to you. I'm going to be writing about you for a couple of weeks. So
no. Thanks, Addison. The pleasure is always mine to talk with you, and I always enjoy it. Thanks.
All right, great.